Is your guy IB. In my last video, I was able to explain irredeemable debts as the cost of debt, right? And also redeemable debt, the cost of redeemable debt using internal rate of return. Now, when we see a redeemable debt in every question or in a real life situation, to calculate the cost of that debt is to use internal rate of return. And I've explained all this in my last video. Now, in today's class, I'm going to explain how to use internal rate of return to determine the cost of debt for the redeemable debt, right? And you should know that I said in my last video, these are the things we should look at in every question, right? And redeemable slash the nominal value is usually 100. But when we get to bond valuation, nominal value could be 1000 or 100, right? When we get to bond valuation. But for the purpose of this class, nominal value is usually 100. Now, how do we use internal rate of return to determine the cost of redeemable debt? It is the positive NPV and the negative NPV. So we already know that these are the ingredients. I call it ingredients that we should look for in every question or in real life situation. Now, how do we determine that? So the cost of irredeemable debt will be, okay, yes, items, cash flow, DCF, present value. Now, the DCF is trial and error. You know, it is internal rate of return. You can use 2. When you use 2%, it will give you a positive NPV. But when you use 10, it will give you a negative NPV, which means that the lower the DCF, the higher the NPV, right? So for the purpose of this class, you say 2%, right? What are the things? This is going to be year 0. Don't forget year 0. This is market value as interest. Market value as interest, right? Interest. So what is the amount? We'll put the amount here as X. What is the DCF as S? What is the present value? Yes. We continue with the interest, right? The interest rate, right? 1 minus tax rate. We look for the tax rate from the question, right? So this person will pay interest from year 1 to year 5. Let's assume 5 years, right? Let's assume 5 years. We have the DCF, the cash flow, and what? The DCF. So how do we determine the DCF? We are going to use the annuity formula to determine the DCF. Since it is from year 1 to year 5, we use annuity formula. Please take note. Now, we have this, then the present value will be this, right? What next is the nominal value, right? Nominal value at year 5, right? At year 5. We still do the same thing, just like the way we did X. So the DCF will be at year 5, then present value. So this we have brackets, and bracket. Thank you.